Welcome to The Explainer. Today we're tackling the ultimate stress test of the banking system. We're talking about the single, absolute metric that literally stands between normal business and total financial collapse. We hear a ton of jargon thrown around when it comes to banks, margins, yields, capital adequacy, but today we're zeroing in on the one safeguard that truly decides if a bank survives a crisis. We're talking about the Liquidity Coverage Ratio, or LCR.
So let's kick things off with a pretty terrifying thought, one that perfectly captures a bank's biggest vulnerability. Imagine you're running a simple lemonade stand, right? But you also hold on to coins for your friends. What happens if, on one incredibly scary day, every single kid shows up at the exact same time, demanding their coins back right that very second? Do you actually have enough easy-to-grab coins to hand back without going into total panic mode? It sounds like child's play, sure, but this exact scenario is exactly what brings trillion-dollar financial institutions to their knees.
Part 1. The core banking loop. Let's just quickly ground ourselves in how banking actually makes its money.
The absolute foundation of the whole industry is what's known as the spread business. Essentially, a bank borrows money from people who have some extra cash sitting around, lends it out to folks who need it, and simply pockets the difference in yield. That's it. That's the entire secret sauce.
But here is what's really fascinating. A bank's balance sheet, it's completely inverted compared to a normal, everyday business. Think about it. That money you just deposited into your savings account, to the bank, that is actually a liability. They literally owe that money back to you. Meanwhile, the loans they hand out to borrowers, those are their assets because that's the money owed to the bank. Kind of wild when you think about it that way, right?
The absolutely crucial takeaway here is that the whole system runs on holding other people's money. A bank's economic engine only works because it's using the cash it owes to generate the assets it owns. And it's exactly this structural inversion that sets the stage for our nightmare scenario a bit later on.
Now, to maximize that spread we talked about, banks rely super heavily on CASA. That's the current account and savings account ratio. Going back to our lemonade stand, these are your friendly neighborhood helpers who let you hold their pocket money for almost nothing in return. To a senior equity analyst, CASA is basically the cheapest source of funding a bank can possibly get. Typically, they target a ratio above 40%. The higher the CASA, the wider their profit margin. But we can't forget, this cheap, sticky money is still money they owe to somebody else.
Which brings us to Part 2, capital versus liquidity. This is where we look at the vital difference between long-term solvency and actual day-to-day survival.
So the first line of defense you always hear about is capital and CARR. People often think of this as the ultimate shock absorber. In banking speak, the capital adequacy ratio measures the bank's own money held against its risk-weighted assets. Basically, it's the required buffer prescribed by the global Basel framework.
To put it simply, think of capital as just the bank's very own pocket money, kept right there in the lemonade stand as a cushion against loan losses. Say a borrower defaults, like a kid chugs the lemonade and just runs away without paying. Well, that loss eats into the bank's own pocket money first, not your deposited money. It's designed to make sure a bad week of lending doesn't completely shut the stand down.
But here is the catch. While capital is absolutely vital for absorbing bad loans, it does absolutely nothing to protect against that opening question we asked. Capital absorbs losses on the asset side, sure, but it doesn't help you at all if your liabilities, your depositors, suddenly show up demanding to be paid out all at the exact same time.
And this builds to a pretty terrifying reality. A bank can be perfectly solvent on capital, yet still completely, totally fail if too many depositors demand their money at once. I mean, you could have a massive capital cushion, but if all that wealth is locked up in 30-year mortgages, you can't exactly hand a piece of a house to the angry mob of depositors in your lobby, right? Solvency is about the long-term math. Liquidity, that's about surviving today.
All right, Part 3, the nightmare deposit run and the LCR. Let's talk about how banks actually survive the panic.
So if everyone wants their money back at exactly the same time, the bank absolutely must have enough easy-to-grab assets on hand. You can't just cross your fingers and hope depositors stay calm. In professional banking, you literally have to prove to regulators that you have a stockpile of highly liquid assets, things like government bonds or actual cold hard cash that can be instantly converted to pay off fleeing depositors without causing a total meltdown.
Enter the star of the show, the Liquidity Coverage Ratio, or LCR. This is a super strict regulatory safeguard, and it's entirely distinct from that capital shock absorber we just talked about. The LCR is essentially the banking world's doomsday prep kit.
It guarantees that when market confidence evaporates and depositors start panicking, the bank doesn't have to forcefully sell off its long-term loans at a massive fatal loss just to scrounge up cash.
And the single most critical component of the LCR? It's this number right here, 30. The entire ratio is modeled around surviving a brutal 30-day stress scenario. The regulators basically force the bank to run a simulated disaster. They ask, okay, what if a huge percentage of your funding just runs for the exits over the next month? Can you survive?
The rule explicitly mandates that a bank has to hold enough high-quality liquid assets to survive that severe 30-day continuous run on its deposits. This is exactly why the liquidity coverage ratio is so incredibly important in the banking industry. It separates the mere illusion of wealth from actual functional survival. If a bank has an LCR well over 100%, it means they have enough immediate cash equivalents to weather a month-long storm of sheer panic. It buys time for regulators and management to fix the underlying issues before the bank collapses overnight.
Moving on to Part 4, Central Bank Control Levers. Let's zoom out and look at how we manage systemic risk across the board. It helps to think of the central bank as sort of the head teacher, setting the ground rules for all the lemonade stands out there. They're the ones managing liquidity and inflation for the entire economy. Since banks naturally want to lend out as much money as possible to maximize their spread, the central bank has to step in as the authority that actually mandates all this doomsday prep we've been discussing.
And to do that, the central bank uses some very strict levers. You have the repo rate, which is basically the master dial that controls margins by setting the cost of borrowing. But more importantly for our focus on the LCR today, they use the CRR, the cash reserve ratio, and the SLR, the statutory liquidity ratio. These are mandatory reserves. They dictate exactly how much cash and government securities must literally just sit there, locked in the drawer, doing absolutely nothing except providing a baseline of undeniable, rock-solid liquidity.
These tools are what ensure the entire banking system is playing by the exact same stress test rules, essentially forcing banks to prioritize liquidity over reckless, unchecked lending. By requiring these reserves and enforcing those strict LCR standards, the central bank puts a hard cap on how aggressive a bank can be when chasing profits. It guarantees that the whole system has enough of those easy-to-grab coins to survive a massive, systemic shock.
So, as we wrap up this explainer, I want to leave you with a final, kind of provocative thought to ponder about where your own money is sitting tonight. Whenever you hear the news say that your bank is highly profitable and well-capitalized, I want you to remember the crucial difference we explored today. Yes, capital absorbs the bad loans, but it is the liquidity coverage ratio, the LCR, that actually ensures the bank's doors can open again tomorrow morning. So, is your bank just solvent on paper, or is it truly liquid enough to survive the storm? Thanks so much for joining me to decode the ultimate stress test.